It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I'm your host. I'm also one of the CFPs on the program. And with me in the KFG studios, my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
Have you filed your taxes yet? Or are you in the process of doing so? We're going to be tuning in to our favorite planning strategies for taxes and helping you think through the 3 questions that you need to ask every year when you get your taxes prepared. We're going to cover that and more on this episode of Wise Money.
I love tax season. I love it. It is what a geek. I don't love taxes. Guys, I do not love taxes. However, tax season, when you're doing planning, that's like, okay, I can calculate how much money I saved. Had I not been working these strategies, oh my goodness, it'd be so different and I'd be paying so much more tax. And therefore, I like when it's sort of final, when you can look and say, okay, look at
how do we do here?
Yeah,
huh?
Look at how much taxes we saved. I just love it. So anyway, we're going to get into that and ultimately help you save on taxes. We're going to give you our favorite tips right now. If you have a question for the program, we'd love to hear from you. Call or text 574-222-2000. That's 574-222-2000. Online, wisemoneyshow.com, and then all over social media, wherever you're at, we are there as well. Search Wise Money Show. So have you filed your return yet? I don't know if it's early or late. We're halfway through. So if you haven't filed yet, this show is going to make even more sense and be even more helpful. But even if you have, or you're in the process of doing so, you're gonna take something away from today's show on how you can pay less taxes over your lifetime. So here's the big idea. Getting your taxes done, tax season, that's an event. It's a reactive event called tax preparation. Tax planning, though, is proactive. It is not looking and trying to get the right number into the right box. It's looking and saying, well, what if I did this legally, guys? These are keep your mind out of the gutter. We're legal tax, like tax strategies. How can you change what you're doing so that you can pay less tax over your lifetime? Lots of times that's less tax today. Sometimes it's paying a little bit of tax today so you won't have to pay it in the future at potentially higher rates. That's why I love tax planning. That's why I love it. So every single year, when you're doing this event called tax preparation, before you file, you need to ask and answer 3 questions. If you're doing this on your own, it's going to be very difficult to answer these questions with confidence. That's why you need a CFP that's doing tax planning with you. We're going to go through these questions, so you've got that in your arsenal, but then we'll share tax tips within these questions as well. First one's really, really basic, but you're going to hate it. And that is, before you file your return, it's done. Your return's done. You just haven't signed the e-files yet. You haven't filed it. You have to ask yourself, do I understand where these numbers are coming from? Does this result make sense? Why is this important?
Well, why is it hated maybe is the better question first. I mean, a lot of times people go to a professional tax preparer because they don't want to have to answer this question. I don't want to know where the numbers came from. I don't want to know why the result is what it is. I just want someone to make this go away for me. And, of course, that's not what we encourage you to do. We want you to sit down with a tax preparer or a financial advisor to help walk through that tax return so that you understand exactly why it is what it is.
And that doesn't mean you've got to sit down for 45 minutes and they're going to talk through every single number, but just a cursory overview. Here's your income, all that there. Here's your deductions there. This is your taxable income. Here's how that's broken up. And here's your tax. Here's your withholdings. That's all it really needs to be.
That's right. And one of the primary reasons that we like to sit down and review that is to, first of all, make sure it's right. You may not even realize that in that stack of documents that you just kind of dropped off to your CPA or to your tax preparer, you may have been missing something. There may be some details that got missed in the handoff or whatever. And so reviewing that together may trigger your memory and realize, oh, wait, this isn't right. Or a lot of times we'll compare it against last year's tax return and say, you know what, this looks different in this area. Are we missing something here?
I wouldn't have said that casual. that is my favorite way to review a return with someone, is not working through the actual tax return, but actually for all the returns that we prepare for our clients here at KFG, the very first 2 pages are a side-by-side comparison of that tax year versus the prior year. And to me, that's where the numbers actually make sense. All right, so wages, taxable wages that came through, this is after your 401k, after your HSA, all those deductions. It totaled this year. It's slightly higher than last year. Does that make sense? Does that sound right? And I can't tell you how many times someone said, no, wait a second, that doesn't
I
seem
made
right.
more money
I
this
think I
year.
made more. And then we're able to dive in and say, oh yeah, remember, it's because you saved more in your 401k, or because that bonus that you thought was going to land on this tax year, it actually was on your last pay stub of the previous year. Remember that? Something like that. And then when you work through interest and dividends and so on, making sure that it's accurate, one, but seeing the contrast is so helpful. It just is.
Yeah, comparing to last year provides some context, and it's a benchmark, helps you kind of sniff out, is there an error here? Or at least be aware of how your financial life is changing from year to year. You may not even recognize, I made a lot more money this year, or this significant change happened. But one of our other favorite things to compare against would be the tax projection.
Yeah, right.
Work that you already did back in the fall.
Yeah, I think the ability for most folks to understand all of the tax changes, and because we spend all day every day working with this stuff, it makes sense. But if you, and I was just talking with a guy this past week, and I was explaining all the tax law changes, and I was telling him what happened in Secure Act 1.0, Secure Act 2.0. He's a business owner, so that really affected him, but it also affects individuals. And people are busy, and people are living their lives, and they're not, most folks are not paying attention to what changes are being enacted by Congress. And so, and that makes sense. Like, I wouldn't spend a ton of time, unless it was my job and I got paid to do it, I probably wouldn't spend a ton of time doing it. But you need to understand how this should help you with your behavior.
Yeah.
I'm remembering back to something that, Mike, I think you said in a recent show, that you kind of elevated the importance of tax planning and being proactive to not like a helpful add-on, but like a baseline requirement of a certified financial planner moving forward. I don't think I'm overstating that.
It's no longer acceptable that your financial advisor ignores your tax planning.
Right.
It's no longer. So early on, 20 years ago, Kevin, when this was kind of woven into the fabric of KFG, no longer just a vision, but actually something we did. It was, this stands out, and it's an add-on, and it's a big help. And now it's a necessity, and the rest of the world hasn't caught up to that yet. But you have to, because it's that important.
That's right. And a certified financial planner who's doing that proactive planning in the fall each year, running a mock version of the tax return, or working with your CPA to do so, they're creating, again, another benchmark, another baseline that you want to be comparing the final results to say, okay, were there any surprises here? Is anything changing? Has our planning actually worked out the way that we intended?
Yeah. All right, I want to go back to one other thing. And Josh, I think you have some of the stats in your head. But the reason why you would go through this first step, and it doesn't mean you've got to be a tax expert. In fact, you're not going to be able to. It's getting harder and harder and harder to be that tax expert, but you still need to answer this question. Do I understand where the numbers are coming from and why the return turned out this way? That can be a very quick overview with your CFP who's helping you with tax planning. But the accuracy, there are more and more paper audits, if you will, right? If you miss a 1099, if you miss I forgot that I got that dividend every year. I forgot that we actually made that change this year. I forgot that, I had this small retirement account that had $400 into it, and therefore I never got, I didn't give you that tax document reporting that income. How many, and I know I'm putting you on the spot, but there's just a significant number of notices that are being sent out.
Yeah, and it's rising significantly. Year over year, way more people are getting these notices. But most audits that are happening with the IRS are not a field audit where they're coming out and sitting down with you. They're sending you mail, and that's how they're getting it done. And it's about 78% of those audits are coming in the mail.
It is astounding. And so just this double check to make sure to do it. Do I have everything? Did I get everything to you? That is more and more important. All right, what are some of our favorite tax tips? These other questions, we've got that and more coming up on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel, 10 a.m. Eastern Time every Saturday morning, also on podcast at the same time, and also on a couple local radio stations. For more Wise Money content and perspective on how you can have wise financial habits in your financial life, make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. We have lots of content that airs right here on this channel all throughout the work week, taking any financial concept that I'm sure that you've thought of and helping you with it, how to think through it, what creative ideas, how could you approach this? So make sure you hit that subscribe button, turn on notifications, leave comments and questions below. We appreciate it. Sorry to put you right there on the spot, but I realized with the accuracy thing, we didn't kind of emphasize IRS is sending more love letters.
Yeah.
So
I think one of the big deals is, especially with the year-on-year comparison, is that there are things that changed in 2022 and reverted to previous amounts or went down dramatically. Mm-hmm. I mean, if you look at oh shoot! Somehow I lost that. Here, it's there are three that I was looking at. The child tax credit was $3,600 per dependent in 21. It's $2,000 in 22. The earned income tax credit for individuals no children was $1,500, goes to $500. Here's the biggie: the child and dependent care credit was $8,000 in 21. Goes to $2,100.
Okay. Can you say that quickly and then we can get into the next one? Because I think that's not just bonus content. I think on the air that would be helpful.
Yeah.
We'll just start with that and we'll transition into the second question. What are the 3 questions that you need to answer every year after your tax return's done, but before you file it? We're helping you with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name's Mike Bernard. With me in the KFC studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com. All over social media as well. Search the Wise Money Show. 3 questions that, as you're doing your tax preparation, helps you immensely with your tax planning, which is way more important. Tax preparation is just sort of the final score of the game. Tax planning is your strategy and execution for how you're going to win. Okay, so first question, before you file that return, but it's done, you review it with your CFP side by side, hopefully comparing it to last year or comparing it to your projection to say, all right, did we capture everything? Do we understand where all these numbers are coming from and why we got the result that we got? This takes 2 minutes. It doesn't take long, but it's that second check for added perspective and added accuracy. Kevin.
Yeah, so there could be a lot of surprises. If you look at what's changed for your 2022 tax return, and that's the one that you're getting done this spring in 2023, in 2021, there was a $3,600 per dependent child tax credit. That went from $3,600 to $2,000 in 2022, so that was a meaningful drop. The earned income tax credit for eligible taxpayers no children went from $1,500 down to $500. Child and dependent care credit went from $8,000 to $2,100. So you might be looking and saying, wait a minute, where's all the money? I got a bunch of money last year and I didn't this year. And to me, there's an attribution analysis that people almost automatically do. And what do they attribute that difference to? their tax preparer.
Their tax preparer
It is
screwed up.
it is so amazing to me because people come in and are like, yeah, I'm paying a lot of taxes. My tax preparer just really doesn't know what he's doing because I used to go have this one guy prepare my taxes and I didn't pay much. And I'm like, yeah, I don't know how to break it to you, but it's probably not your tax preparer. The thing that I want to talk to my children about, the eligibility rules have changed to claim a tax credit for clean vehicles. And we've been trying to get them to clean their vehicles for years. And if I tell them there's a tax credit related to clean vehicles, they just might do it.
We need one for clean bedrooms, too, in our house, I think.
I don't see that.
You know what, though? And that's a good point that you bring up, Kevin. Part of the reason why it's important to just pause and review the outcome of your tax return is to be aware of those types of tax law changes. Your life may have been completely stable from year to year, and yet the tax laws are changing on you, and it can swing the results of the tax return pretty significantly. Or the opposite could happen. You know, there may be years where there are no meaningful tax law changes at all, and yet your tax return can change substantially from one year to the next, just simply because you go from being eligible for certain write-offs to no longer being eligible. And I think it's important. There are many times when we'll sit down and show a client, hey, the only reason you have a refund here is because you got that tax credit, and that tax credit's going away next year.
Yeah.
And if you don't pause to have that conversation and be aware, next year there's a surprise coming potentially.
And that is going to be question number 3. We're not going to jump there now, but if you don't answer question number 1, you're not going to be able to answer question number 3. And that's the most important one if you were to ask. Okay, that is. And you can't answer question number 3 without answering question number 1. All right. Now,
For those who just tuned in, question number 1.
I feel like I'm at Dr. Seuss, like some sort of Dr. Seuss. Now, okay, so question number 1, do I understand after your return is done, but before you file your tax return, do I understand where these numbers are coming from and why I'm getting the result that I'm getting? This is not a thesis and some sort of in-depth review of your tax return. It's just an overview of the results of your return. Second question, before I file, is there anything that I can do right meow?
Jeez.
Right
your
now,
new favorite
it
joke,
is.
isn't
I
it?
love it. And it's yeah. So, is there anything that I can do right now to improve last year's return before I file it? And you might think, hasn't that ship sailed? No, there's actually a few things. Some of the things as you review and answer question number 1, you're going to look and say, yeah, this turned out different and there's an opportunity here for the future, but we can't do anything about it now. But there's some things that you can do before the tax filing deadline, April 18th this year, to improve last year's return. Guys, why is this important? And then let's get into our favorite tips here, some of the strategies.
Well, I think it's important because a lot of times you do get to tax time, you're ready to file the return, and for whatever reason, it's not the outcome that you thought. Maybe something changed at the very last minute in the prior calendar year, and it really skewed your numbers or changed what your tax picture is looking like. And it's important to know that there are still some weapons you have in your arsenal. There's tools that you can use. There's levers you can pull, whatever metaphor you want to use. The point is, it's not done until you file. And I'm talking about things where you could make a contribution up until your tax filing deadline. You have these bonus months where last year is done, it's in the bag, and yet you still have the power to influence it. And sometimes that can make the difference between you being right on the edge of a certain tax bracket, being eligible for certain tax credits, and or maybe having to pay back some credits if you were on the Affordable Care Act, for example. So there are some things that you may want to do at the last possible second here to influence that tax picture.
Before we get into strategies, and you mentioned some of them, and we're going to break them down for you, but the other reason why this is important is, what if it was a good idea and it makes sense on your tax for your taxes, but by December 31 you didn't have the cash? You didn't have all the cash that you needed to fund that IRA or that SEP IRA, and now you've got a couple more months where you've been able to stockpile some cash. Now, if you extend that out every single year, eventually that might catch up to you. But yeah, I would like to put I'd like to fully top off the HSA because that will help for several reasons. I just didn't have the cash flow to do it, but I got a bonus, or I've got some, cash gift around the holidays, or I'm about to get a refund on my return, and I can use some of that refund to fund some of these things. So these extra couple months also give you some cash flow potentially to attack some of these things. So what are they? My favorite's the HSA. My favorite is the HSA, where you've got up until April 18th to make a contribution for last year. And oftentimes, here's why it's my favorite, because we're all going to have medical expenses out of pocket. Mm-hmm. We know that retirement savings are getting more challenging, and they're changing some of those rules there. And the HSA is a fantastic vehicle for retirement if you repurpose it that way. And yet so often people contribute to the HSA based on, here's what I think I can afford out of my paycheck, or here's how much medical expenses I think we'll have. And then you get to the end of the year and you look at their return and you say, there's an extra $1,000 you can throw in your HSA. It can save you a couple $100 on your return. Make sense? Mm-hmm. So,
well, part of the reason we love the HSA is because it gives you that upfront tax write-off that will influence last year's tax return, but it also comes out tax-free when you use it for medical expenses. So there are just not very many opportunities that you have to save tax on the front end when you make the contribution, and on the back end when you take the distribution.
All right, now I'm not a gambler, but there's this thing called a parlay. And I don't know if that's more of a universal term, or if it's just in gambling where you say, okay, well, I think this team's going to win in this game. I think this team's going to win on this game. And I think this team's going to win on this game. And if you get all three of them right, then your odds are obviously really diminished, but the payout would be bigger. So let me parlay the HSA. If you're on Affordable Care Act, and you want to make sure it's affordable, if you're on health insurance from healthcare.gov, and you select an HSA eligible plan, and you do your return and blah, 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 and it looks like your income is going to be higher than what you originally stated it would be when you got that health insurance from healthcare.gov. And you're going to have to pay, when you look at your return, you're going to have to pay a lot of those premium tax credits back. And usually this is, a couple dollars over opens the floodgates where you owe so much in taxes.
It's like the ultimate surprise on a tax return.
So you look at that and you say, well, you're going to owe $6,000 on your return because you made too much money. You weren't planning on going back to work part-time. You weren't planning on something, whatever, and you're going to owe $6,000. Instead, what if you put $5,000 into an HSA because your plan, the health insurance you chose, is HSA eligible? If you put $5,000 in an HSA, now you're going to be below those thresholds, and you actually break even on your tax return. Or it makes an enormous swing when you're on. That's where when you're looking at healthcare.gov and you've got choices, and some of them are high deductibles, but some of them are high deductible HSA eligible. You got to pick that one. It's going to be a little more expensive. You have to, because it gives you this option just in case your income gets a little out of hand. So, all right, there's a few other tips, our favorite tips, things that you can do after December 31st, but before April 18th. We've got that and more coming up on the Wise Money Show with Korhorn Financial Group. Sorry, I feel like I talked a lot there.
Yeah, I think my favorite parlay.
I've heard that phrase before, but there's no way I could have given it.
Some of the people on YouTube are like, these guys have no concept of life. What is it? Because I think this is,
Dude, my favorite is the ice cream parlay. That is where I'd like to be found.
There's just been, I wonder if there needs to be a show on this. I mean, there has been an explosion in the online gambling, sports betting stuff.
Oh, yeah, they're setting all kinds of records.
Oh, yeah. And so obviously that's a financial decision. It's entertainment, but it's a financial decision. I wonder if we should do a show on that and talk about that a little bit. So I won't belabor it, but okay, I will. Friend of mine does this, and I talked to him about, are you parlaying any games or whatever today, whatever day I saw him. And he said he looked up one of the companies, publicly traded company, their stock, and he was looking at their financials. And he looked to say, how much profit do they make from a straight bet versus parlay bets versus whatever, to look at it from I'm an investor. And they make so much money on parlays. Wow. And so he said, it's more fun. It's more entertaining, but I'm not doing it anymore. Because essentially that tells me the odds are worse.
Right.
So there's the tip. So
There you go.
all right, third segment.
Well, I can tell you this: there's an addiction issue,
Oh, yeah.
for
and
sure.
that it has to do with dopamine and
yeah.
understanding all of your.
The thrill of the potential of a win, all
Right.
of that.
All right, here we go. Third segment. What can you do to improve last year's tax return after you've completed your return but you haven't filed up until April 18th? We're giving you that list, our tips right now, and then one other big question you've got to answer every time you file your taxes. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name's Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on YouTube, as well as a lot of other content. Go check it out. Go to YouTube, search the Wise Money Show, subscribe to it there. All right, so first question. Every time you're getting your tax return done, you've got to know where the numbers are coming from, why you're getting the result that you are getting. Second, before you file that return, you've got to run through the list of options. What could I do to improve this tax return before I file it? HSA is one of them. Guys, what are the other options to consider? Our favorite tips.
Well, one of the reasons I like the HSA and the example that you gave in our last segment of someone who maybe is surprised and finds out that they're going to have to pay back some of the premium tax credits that they got on their health insurance through the marketplace, through Affordable Care Act, is you can start actually stacking some of these strategies. You can make an HSA contribution and make a traditional IRA contribution potentially. And now all of a sudden you're getting multiple write-offs at the last second that helps bring your income down and maybe makes you more eligible for some of those credits that were being taken away from you or that you were being forced to pay back. So all of a sudden you can really swing a tax return at the last minute by stacking contributions. Of course, you have to have the cash to be able to do it.
Yep.
So let's not lose sight of that fact.
And you've got to be eligible, income
That's
eligible, and know those rules. Another one, so traditional IRA, another one that's just like that is the SEP IRA.
Mm-hmm.
And so I think that simplified employer pension, it's more like self-employed pension is really what I would kind of rename it to. Because if you've got side income or you're self-employed, got the side hustle, whatever, then that opens up another opportunity. Sure, you could do an HSA if you're eligible for that, a traditional IRA if you're eligible for that. But if you've got self-employed income, you could also do a SEP. And again, you need the cash flow, but we've seen this significantly swing someone's tax return quite a bit. So that's another option.
And you have up until your tax filing deadline to make that one.
Yep.
With extensions even.
Yep.
Right.
So you can buy even more time for yourself all the way into the fall to make a contribution like that one. If you've extended.
I'm just looking at Mike and picturing him with extensions. So I do think the other thing that you can do, especially if you're self-employed, is if you have a solo 401k. Now, that has to be set up before 12/31, but that is, you can fund that one up until your tax filing deadline, including extensions as well.
Are we going with solo 401k, solo K, single K, self-employed 401k?
One man, one woman retirement plan.
Keogh plan, that's going way back. These things, they're all mean the same thing. You then, of course, can also do the Roth IRA. And gosh, this is like the one financial program where the Roth IRA is listed last. Everyone loves the Roth. We do too. However, it's an opportunity that you could fund up until your tax filing deadline if you're eligible. It's not going to help you on your return last year. It'll help you on future returns, tax-free growth. Mm-hmm. So, and then the last thing that I would mention, guys, I don't know if you have anything else, but we got to get to the third question too, but maximizing the retirement savers credit. Mm-hmm. Oh my goodness. This is my favorite, one of our favorites. And you're looking at your tax return. Oftentimes you've got to do this retroactively, where you're looking at your completed return, you haven't filed it yet, and you're looking saying, oh, wow, our adjusted gross income was actually below the threshold, and we get this special tax credit for doing what we should be doing anyway, and that's saving up for retirement. Have we maximized that? And the reason why so many people don't is if your income's below the thresholds such that you're eligible for this, oftentimes, if you're married, it's just one person contributing, not both, because your income is low, because your spouse is working part-time or not working at all. But the tax credit is optimized on the first $2,000 that each of you would contribute to your retirement accounts.
Right. So you will save more money getting more of this credit if you and your spouse each contribute $2,000 instead of one spouse contributing $4,000.
Right.
You'll be able to effectively double your credit.
Yeah, and to get you in the ballpark for 2022, it's it phases out at $68,000 of adjusted gross income. So I would want you to be asking your tax preparer or whoever is helping you deliver your tax return and receive it to just ask them, is there anything that I could do or could have done to change my tax picture for last year?
Yeah, I mean, that is the second question. And ideally, you're not having to force that. You're not having to ask yourself that and wonder. Your CFP is guiding that discussion. And really, for this second question, they're actually running through the list of the things that they've already helped you put in place. I love when I'm delivering a return and I'm saying, listen, the tax strategies that makes the most sense for you, maxing that 401k, funding that HSA, contributing to the Roth, you've done all those things. You've done everything that you can do to make this tax year look as good as it possibly can. Well done.
Yeah. Can I throw out one more for business owners or self-employed individuals? If you're someone who made a significant purchase of a piece of machinery or equipment or some significant business asset in the prior year and you put it into production, you put it into use last year, you're going to be making a decision on this year's, when you file the tax return for that year, on how you're going to write it off, so to speak, or how you're going to deduct that expense. You can either spread it out over the life of that asset, or you can take it in a more quick, upfront way. And a lot of times the right answer, it just depends on, well, what kind of impact is it going to have on my tax return over the years of that asset's life? You have discretion on this. And you don't have to make the decision at the moment that you put that machinery into production. It's when you file your taxes. Mm-hmm. So sometimes it makes sense to pause long enough and think through, all right, if I take the deduction this way, what's the outcome? If I take it this way, does that one make more sense? That again, it's unique to a business owner or to a self-employed individual.
Yeah, what Josh is referring to is depreciation. Because basically, if I depreciate this asset this year, because the question is, what does my income look like going forward? And because if I have a lower income year, but I bought this amazing piece of equipment and it's going to allow me to triple my production, I might want that depreciation to be pushed into the future instead of taking it all this year. And it's very tricky. It's kind of the marshmallow experiment. Because you say, all right, if you don't eat the marshmallow in the next 5 minutes, I'll give you a bag of them. And you just go on YouTube and watch. Those kids, they almost all eat that doggone marshmallow.
I know. And oftentimes you look at business owners and oftentimes they say, no, I'm looking forward to this next year and I can anticipate certain things, but I don't know. Give me the full deduction right now.
Yeah, because I want the tax savings right now. I want that bigger refund.
That
so as long as we're talking business owners and pet peeves, at the end of the year, they say, I had a good year. What should I buy? Uh-huh. And so my question is always, well, what do you need? Yep. And it's not what do I need? It's what should I buy so that I can pay less in taxes? I'm like, well, don't buy anything that you don't need.
Because if you don't need it, then you're spending that money unnecessarily. If you do need it and getting a tax write-off, that tax write-off is a percentage of what you spend. Mm-hmm. Mm-hmm. Right? So if it's unnecessary, then you're spending a whole bunch of money that you shouldn't.
Right.
It's hard to turn down the temptation of a cool new tractor or a big new truck or new piece of machinery sometimes, though.
Yeah. All right, let's
it is.
transition then to the final question. So there's 3 questions you need to ask yourself and answer every time you file your taxes. And this is going to help you with your tax planning. The first, do I understand where all these numbers are coming from, why I'm getting the result I'm getting on my return? Number 2, is there anything I can do before I file to improve my tax picture? And then number 3, let's just start, before we get into tips, guys, we're not going to have enough time to unpack that right now, so let's just talk about why it's important, is what's changing in my tax picture this year that I need to adapt my behavior for or plan for right now?
Yeah, this is important because you want to catch the changes, the pivots that are happening in your financial life as early as possible in the calendar year. If you need to be increasing contributions to a retirement plan, or maybe you are under withholding on taxes, you don't want to wait until the fall or until next year's tax filing to realize, oh, I could have been withholding just a little bit more out of every single paycheck throughout the year, and I wouldn't have a problem, but a year from now, a problem may be brewing.
There is a long list of potential problems, but big opportunities that are our favorite tips that you've got to consider when answering this question, and really how would you answer this question? We're going to run through that list and help you with this. We've got that and more coming up on the Wise Money Show with Korhorn Financial Group. All right. This will be definitely the full segment.
Mm-hmm.
So,
Is this number 4?
yes.
Mm-hmm.
I feel like I'm hungrier than normal for this time of day.
Oh, Mike.
So it's daylight savings time catching up to you.
Yeah. It was nice to see the sun when I was coming in this morning.
That very much stood out to me,
What
too.
is that thing?
I know. I did.
Oh, I could barely see.
You can tell it's we're seeing it earlier, but actually seeing it is the other key. No clouds.
People in Florida and California are like, what are these nerds talking about?
The
No,
sun.
I know. Well, you know what? The other interesting thing, my dad sent me sunset pictures on Sunday, and it was still sunny when he sent them to me.
Oh.
So the sun, and I didn't think that was even possible, that we had any advantages at all over Florida, but we might have a few extra minutes of daylight.
Yeah, I bet.
Is that even
the
possible?
Sunrise is a little earlier.
Theirs
there
would
too,
be
then.
earlier, yeah. They're just further east
Nice
is
try.
all.
Nice try. No.
I
this
think
a-
they get
okay,
more
okay, smart
because
guys.
Is this
All right,
the list
okay.
that you making a list for
This-
Lori to
the
say
sun is-
no? Let's not look at all our advantages here in the Midwest.
the realtor told you that one, right?
I am telling you, this is the best place to live,
I know that.
regardless of
Here we go.
sunshine content.
All right. Thanks for being here. This is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. Here with me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on podcast wherever you listen. Search the Wise Money Show, subscribe to it, or follow us there, and then rate the program. We appreciate that. This show, actually, the entire idea of this show is to help you make wise financial decisions by looking at all 6 areas of your financial life. And as you've got choices, okay, which one is going to bring the most benefits to as many areas of my financial life as possible? One of those areas is tax planning, not tax preparation, getting your taxes done. That's just compliance. And there's no planning needed with that. It's just getting the right number in the right box. That's just, doing what's required. Tax planning, though, is, Kevin, I love how you've elevated this. It's paying the least amount of tax over your lifetime, if not multiple lifetimes. Who wouldn't want to do that? Right? That's what even Congress folks who write the laws, who say people need to pay their fair share, they're doing it too. No one's going to contribute to their 401k and say, I don't want the deduction. You know what? I'm going to contribute pre-tax, but I want to pay the tax. I'm willing to. No one's doing that. No one is doing that. Okay, so what are the legal ways? What are the laws? What are the entire, I'm on a soapbox, guys. Someone's going to need to reel me in. The entire tax code is behavior manipulation. They are trying to manipulate behavior. So what sort of behavior manipulation is stuff that you want to do or should do anyway, and you can get some benefits for doing it. So you got to ask yourself and answer 3 questions every time you do your return. 1, do I understand where these numbers are coming from, why I got the result that I got? That helps you with accuracy, helps you avoid notices, helps you make sure that you didn't miss anything and that what actually happened lined up with what you expected. 2nd, is there anything you could do right now before you file to improve last year's return, HSAs, IRAs, SEP IRAs, those sorts of things? But then the 3rd, and this is where the rubber meets the road, is anything changing in my tax picture or finances this year that I need to start planning for right now so that I don't show up a year from now with a big tax surprise or missed opportunities. So what are some of those, guys?
Well, I think that the easy ones, if you're either younger or older, am I adding a child tax credit or am I losing a child tax credit?
Right.
And I could actually lose a child tax credit because my children age out of it, or I could lose it because my income phases me out of it.
Yeah.
The one that I think is most frustrating to people is my child ages out of it. Because I think logically you would say, well, I'm going to get this child tax credit as long as I've got this child. And that is not true. That is not how they have it set up. It's
to age 26, wouldn't that make sense?
That would make sense, or at least age 18 or age 21, some other logical numbers that society and our culture has said these are times when kids start to become adults, or at least should.
Right.
No, this is age 17. The year they turn age 17, no more child tax credit.
That's right. You're referring to one event, having a child, or that child becoming an adult and no longer being eligible for certain credits. There's other life events that can change someone's tax picture pretty significantly as well. Getting married obviously changes your tax picture. You're filing in a completely different status. You have different tax brackets that are applying to you. You're maybe merging two financial lives and two incomes together. So everything is changing when you go through that type of a life transition. Retirement would be another one. Mm-hmm. Going from your working career to now living off your investments or living off Social Security and pensions. That's a swing. It not only could change what tax bracket you're in, but even how you pay your taxes. You're used to paying your taxes out of a paycheck every single pay period. Now all of a sudden, you're needing to plan ahead a little bit more. Maybe having to take certain distributions from your IRAs to cover your taxes, or maybe making quarterly estimates. So, just being aware. This is part of the reason why tax planning is such an important part of a financial plan. Mm-hmm. Like your financial plan needs to be steered by your tax picture and vice versa. So to me, the goals that you're achieving and those life transitions are really what you have to be talking to your certified financial planner about every single spring, because some of these can sneak up on you at times.
Yeah.
Yeah, I think of a couple situations that I've seen recently. One is we met with a prospective client, and one of them was eligible for drawing Social Security, and they were 70 plus. And so your Social Security benefit doesn't grow a penny beyond 70. Now, if there's anything redeeming in there, you can go back 6 months.
Yep.
But I think, all right, if you're working, if one or both of you are working outside the home, and you say, hey, we can turn this on. Another one I saw, this person had a pension, and as we're looking at it, and I'm thinking, okay, this pension is from a few jobs back. It's been a while. Is this amount growing at all? No, the pension amount isn't growing. So how many years do you want to take a pension amount that won't increase at all based on your age and not do it? But if you say, wait a minute, I'm working right now and I'm going to draw, if I start drawing this pension, what does that do to my tax situation?
Right.
So this is where tax planning is so crucial, and you just want someone looking over your shoulder saying, hey, listen, if you zig instead of zag, your financial life just got way, way better.
If you changed jobs last year, when you do your taxes, this is one of the issues or answers to question number 3. What changed in your financial situation that impacts your planning for this year? Even if you do your return and say, oh yeah, everything came out copacetic, everything looks all right, you've got to look at your pay stub to say, okay, wait, I know I changed jobs, and even though you think you filled out that W-4 the exact same, if that company is using the new withholding tables, but you were on the old withholding tables or whatever, it may not be the same. And when you just look at a partial year because you changed jobs last year, you might not see that you were actually, there were some issues. But then a full year of 2023 might expose, oh no, you've got a problem here. You're not withholding enough.
Mm-hmm.
Yeah, and that the big one is I live in a state and work in a different state.
Yes.
And so if you moved last year and you move to a state where you're not working, it's so incredibly easy for that to get messed up, either in your withholdings or when your taxes are prepared. And so I would tune into that. But the other thing is, if you moved states last year, and it'd be easy to move states, we're right on the border of Indiana and Michigan. So you move from Indiana to Michigan or vice versa. One thing that you need to understand is the 529 plan, because everything changed. You went from getting a credit to a deduction, or a deduction to getting a credit. And should I really fund a 529 plan? Well, now that there are options, and this is now estate planning and a number of other things, areas of your financial life are impacted by your 529 plan decisions. This is where you need to be sitting down with your financial advisor and saying, hey, can you give me tax advice? And if they say, I can't, go talk to a tax advisor, you need a different.
Absolutely.
Yeah. You're right. Mike, you said something earlier. When you're doing tax planning, you want to align the tax code or the opportunities in the tax code with the things that you already want to be doing anyway in your financial life. You know, your financial plan is pointed towards certain goals, certain objectives, and if you can take advantage of tax laws that help propel you towards that, you know, that's a huge win in your financial planning. And an example of that is just your own retirement savings. You know, if you've got a big goal and you're maybe trying to play some catch up on a retirement funding goal, trying to get to a certain size nest egg by a certain age, making sure that you're maxing out your contributions wherever possible, I think is a big deal. Recognize that just this year, the amount that everyone can contribute to a 401k jumped by $2,000. It's $22,500 now. And if this happens to be a year where you're turning age 50, you can do another $7,500. I would want you to take inventory of that and recognize it here early in the year so you can make adjustments to your contributions and hopefully take full advantage of these bigger buckets for retirement.
If you've been wanting to or have been maxing out your 401k contributions or 403b and you turned 50 this year, your contribution limit went from $20,500 to $30,000. That's a big increase. That helps make a big difference on your taxes and in your retirement picture. If you're able, I'd want you to capture that and be aware of that earlier in the year. Guys, we didn't even scratch the surface. There's a lot more. You need tax planning, working with your certified financial planner who's doing comprehensive financial planning. All right, that's all the time we have for today. On behalf of Josh Gregory, Kevin Korhorn, all of us at KFG, have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.